Investors waking up this morning to a recession warning from the bond market. Steve Liesman joins us now with more. And Steve, we were going to talk about the deficit, but obviously the conversation today has changed.
Yeah, to a less expensive deficit, at least in part. But first, let me just do them. To make sure everybody's up on the conversation. An inverted yield curve is where short-term bonds yield more than long-term bonds. It's supposed to be the other way around because investors want higher interest rates if they want to lend you money for a longer period of time. But the 2-year and 10-year, well, bonds, they flipped this morning for the first time since 2007, and it's pretty tried and true recession warning. Take a look. 3 inversions going back to 1985. Each one, those are the circled ones. Each one curtain raised a recession by anywhere from 13 to 17 months. Notice I did not circle the recent one because we don't know if that leads to a recession. How did we get here? Well, the Fed cut rates, and markets kind of thought that was not enough. That was a big, like 10 basis point decline in the yield curve. Then you had a trade war escalation and then a de-escalation, at least for now, and a stronger than expected CPI inflation that pushed up the 2-year bond yield, which is why we inverted this morning. Here's what the market expects from the Fed in coming months in context of all this. Going to get a rate cut in September, 100% probability, 73% chance of yet another rate cut in October. And we don't have that third rate cut dialed in from here until January. It's in the 40%. It's the 40 percentile for December. So big caveat with a capital C here, folks. No one knows if inversions mean the same thing today as they did a decade ago before yields were so low. In fact, the yield curve inverted when the 2-year rose after the president delayed some tariffs. That was a positive development. And of course, Kayla, you've got negative interest rates. I think the count is $15 trillion. So, and one other thing, we don't think that yield curve inversions cause the recession. They reflect concern about a recession, but it shouldn't be something like, oh my God, it's what causes it. It just reflects.
Good point, though.
Right.
If short rates are like,
who knows?
6%. That's much different than if they're 2.6 versus 2. Plus, when was the first part of the yield curve inverted? Have we been?
Yeah, we've been
March,
like a
March.
year.
March. I got to go back to for the 3-month tenure, which is, by the way, the inversion. The Fed follows.
Right. It's whether you're talking about the entire curve or just this 10-2 spread.
Right. I mean, look, it's something to worry about. Look. You see a bond yield. It reflects the combined interest of investors in trillions of dollars in bonds in their outlook for growth and inflation and all sorts of other things. The Federal Reserve is out there. So it could be anything happening here. You have to watch it.
I want it to be a good thing for the first time in history because it reflects innovation and low and secular disinflation around the globe. I want it to be a good thing. We keep the pedal to the metal. We got low unemployment and inflation is so low that we can have low interest rates too. We can have it all.
I could give you a serious answer to that because I share your aspiration in that regard.
That'd be nice.
But in that world, why would short-term money cost more than long-term money?
Because it's a couple basis points.
No, but
it's basically all the same.
Joe,
it's basically all interest rates are basically the same, except the rest of the world.
Everything's the same. It sounds like an Alvin Toffler kind of thing.
It probably isn't going to be that way, but it is. Lower interest rates in general
are good.
Are good.